What's going on, everyone? And today I'm going to share with you the two purchases I made to my investment portfolio in February. So as you can see here, my financial freedom investment portfolio is at $34,420. I'm a dividend growth investor, and every single month I contribute to this portfolio to purchase dividend paying stocks to increase my yearly income and to one day build this up to where I can live sustainably and be financially free. So in this month of February, I actually made two purchases. I purchased PPL, Pembina Pipeline. I purchased 22 shares. And I also purchased VRE, Vanguard's Canadian REIT ETF. So for that, those are my two purchases, and I'm actually going to go through each one very briefly and share with you why I purchased it, my outlook on the company, and what I think is going to happen moving forward. For both of these are extremely long-term holds. They both pay a very nice dividend. The Vanguard REIT ETF pays a dividend of around 3%, and PPL, the pipeline company, actually pays a dividend around 4%. It just so happens that both of these are actually monthly paying stocks / ETFs. PPL is actually just an individual company, but they do pay their dividend monthly, and VRE, it's an ETF, which also pays out its dividend every single month. For me, I really don't care where my holdings pay. It can be monthly, quarterly, semi-annually, or even yearly. That doesn't really make a difference to me. All I care about is the total return, the continuously increased dividends, and I want that constant cash flow over time. When I actually receive that cash flow, whether it's every 3 months, every month, doesn't make too much of a difference. It actually just so happens that these two companies do pay monthly. So as always, I'm just going to get started and jump right into it. So for disclosure, I actually purchased PPL in January, but I didn't make a video about what I purchased in January, so I'm just throwing it into the February video. And I actually got a great deal. So if we just jump back to my portfolio, as you can see for PPL, I purchased 22 shares at a cost of $48 a share, and I'm already at an increase of close to 11%. 11% jump in 2 months in price appreciation. For me, I'll be honest, that was luck. I didn't strategically plan for that jump. Like I said, I'm a dividend investor, so I really just care about the consistent growing dividends, and price appreciation is just a little bit of a bonus, and that's what it is here. If I take you to the chart, so the year-to-date chart for PPL, as you see, I purchased this early January, and I actually purchased this on Wednesday, January 8th. As you can see here, it was $48 a share. Then the next day, a big 4.3% gain, and over the month of January, it's increased close to 11%. For me, what happened with this is I purchased this company just because I did my analysis and I liked their future outlook. And then the day after I purchased it, which I heard about this, but I didn't know it would be confirmed, they announced a major new pipeline, which would bring in billions in dollars in revenue over the next 5 to 10 years. And for that shot up the stock price. That really led to a strong increase in the price. And as you can see, in a short 2-month span, I've actually earned over 11%. Very nice to see. It wasn't the reason I bought the stock. I didn't buy it for that price appreciation. I bought it because it pays a nice dividend. As you can see here, my dividend when I purchased it was over 5%, because right now it sits at 4.74 at the current price. And I actually purchased it, like you saw, at $48 a share. So it is a nice dividend. And like I said, this one pays a monthly dividend of 21 cents a month, or $2.52 a year. So I can show you why I purchased PPL. I understand oil and energy and stuff like that. It's kind of an interesting industry because we don't know really what's going to happen moving forward. But for me, I like PPL as a little safe play. It's a pipeline company. So what it does is it transports oil and natural gas to and from other places across Canada and the United States. And what PPL does is they don't really need to produce it. So the price of oil does have an effect on that, but it's not largely impacted. So even though people are switching everything to renewables and stuff like that, and I understand, I do hold some renewables companies, which I'll talk about in different videos. But for them, I really think PPL's company is going to be around for a long time. I still think we're going to be needing the oil, the gas for the next 30 to 40 years in our society just to function our day-to-day lives. I do believe energy and stuff is going to come soon, but I just don't think we're there yet. So this is why I purchased PPL over some competitors, and what made me really draw to the stock is I don't do a lot of technical analysis when I'm purchasing stocks, but I do look at some important factors. So for me, I like to look at the financials. That's one big thing. I like companies who are increased revenue, increasing income year over year. So as you can see here, we'll start at 2015, 4.64. This is in billions of dollars. Slight decrease in 2016, but I'll tell you why I don't mind that. 2017 went up, 2018 went up. Strong increases in revenue year over year. And what made me disregard this 2016 slight drop in revenue was that net income. So this is net income. So this is how much profit the company made. As you can see here, in 2015, 0.36 billion or 360 million. So then the next year, even though there was a slight decline in revenue, net income still went up. So it really drew me to this company that shows that even if revenue dropped slightly, they're getting more efficient with their operations. They're producing more with the same cost. They're being more efficient. So for that, they actually increased income on a year where revenue had a slight decrease, which is something I like. Then move on to 2017. As you can see here, they almost doubled their net income. They more than doubled. Moving on to 2018, as you can see here, again, very large increase, about a 50% increase in net income. So for me, that's the things that draw me to a company. I really want strong companies who are increasing their revenue, increasing their income year over year. And as we'll just go to the dividends here, I'll show you another attractive part to this company. So like I said, I purchased at around a 5% dividend. As you can see here, for this company, they paid an increasing dividend year over year. That's another important part, is I only purchase stocks that actually increase their dividend year over year. Because of inflation, I need companies that increase my cash flow each year at a rate higher than inflation. So if this company or all my companies usually have to increase their dividend by at least 3% a year to match inflation at least, in order for me to purchase the company and then to meet my specific personal investing criteria. So as you can see here, PPL's dividend in 2018 was $1.80 a share. Then 190, then 204, 224, 236, and the current dividend per share is $2.52 a year. So for me, that's what I like to see. It really has been going up and up over time. These payout ratios, they're a little skewed because of some financial data that I looked into, but I'm not going to get into that depth in this video. But the current payout ratio sits at just about 75%. I do have to admit that is a little high, but for this type of company where they have consistent revenue streams coming in because of their operations, I am okay with it. Because they have very predictable revenue going forward, they have these new projects that are increase their revenue and increase their income coming forward. They have contracts for those already. That high payout ratio, I'm actually okay with in this case. As you see down here, just show you the month by month dividend history. Like I said, this is a monthly payer, 19 cents a month, up to 20 and up to 21 cents a month, which matches their dividend increases that I've already shown. So those are the reasons why I should purchase PPL. I still think it's a great long-term buy. Strong dividend. My yield on cost is around 5%. And then from there, that little bit of price appreciation is always a bonus. With the increasing dividend, I really think this will be a great long-term hold. The next thing I purchased in February was VRE. So like I said, it's a Vanguard Canadian REIT ETF. For me, I don't like doing analysis on REITs. I don't understand them as well as I do everyday companies because they use different metrics and stuff like that to value how strong a REIT is performing. And tiered with that high payout ratio that REITs have to maintain, I'm not too sure I want to pick and go into individual REITs myself. So for me, something I recommend to everyone who doesn't want to go into it is a low-cost index fund or an ETF that gives you a little bit of diversity in the same sector so you get everything you want with a little bit less risk. So that's what I did here. And for me, I use both dividend growth investing and ETFs. So for my international markets where I don't want to get in too much into it, I'm going to be purchasing index funds and ETFs just to track the market in those areas that I'm not an expert in. And then for REITs, like I said, another sector that I really don't want to spend too much time getting into. So I'd rather just purchase a low-cost ETF and go from there. So I went with Vanguard's, spots a 3% dividend yield, which is great for everything I need because it does have strong price appreciation. As you can see, long-term gain 40% in less than 10 years. So it's good. And I'll just move on to the next chart and show you exactly why I like this. So as you can see here, like it says, Vanguard Canadian Capped REIT Index Fund has about 17 different holdings. And as you can see, a management fee or a MER, a total of 0.39%. So 0.4% is somewhat high considering you can buy like an S&P 500 index fund for almost nothing at like a 0.04% fee. But what this is this is actually the cheapest option of the three big REIT ETF players in Canada. The one from iShares and BMO, the two other index fund and ETF companies, their fees were both around 0.6% a year. So Vanguard had the cheapest, which is what they're known for. And I have a personal bias. I do like Vanguard. They're just a strong company in my opinion. I like everything they've done, and I like the leadership at Vanguard. So for me, I went with them. They are the cheapest alternative, and I compared the 3 different results over the past 10 years, and all 3 ETFs, because they hold similar holdings, did perform somewhat equally. So for me, I just went with the one with the lowest cost. So that's my Vanguard. And that's what I did for this one, and that's a little overview. And I'll just show you here the performance. Since inception, when this was first created, it's averaged 8.73% a year, which is perfect. That is exactly what I'm looking for my portfolio. I'm not a crazy investor. I don't shoot for 20% a year. I'm not one of those guys yet. I don't want to time the market. I just like throwing cash flow into the market, letting it grow and increase my cash flow year over year. So for me, that's everything I need. My whole portfolio, I would like between a 6 to 8% annual gain over the long term. Sitting at 8.3% since inception is perfect for me. There is no 10-year results yet. This has only been a fund for about 7 to 8 years. So there's no 10-year results, but that's okay. 7 to 8 years of results works great for me. Then I'm just going to move over to the dividend and the dividend payouts, which is something very important. But then as you can see, the fund holds 17 different companies, like I said. And this is another thing I really liked when I was looking at picking this ETF. It's very diversified in different mini sectors or subsectors of the REIT industry. Industrial and office REITs make up 30%. I understand the difference in the way we're going now in society where a lot of people are working from home, but I still don't think industrial and offices are actually ever going to go away completely. So having about a third of my money in those REITs, I'm okay with. 20% in retail REITs. That was very important for me. I did not want to choose an ETF with a high retail sector, only because I really don't know what's going to happen in the retail industry and the ideas such as malls and actual physical stores going in the future. So I don't want to tie up a huge amount of money in them right now. So having 20% in there is good enough for me. 1/5 of my money in this ETF is going toward retail, and I'm good with that. Residential, I really do love residential REITs only because people always need somewhere to live. I've looked at the residential REITs this holds. They hold Canadian Apartment REIT, which is a very large REIT in Canada. It's one of the most popular, which holds thousands of individual apartment units that are low cost, which is, I believe, will never go out of business only because we will always need cheap places to live. There will always be a sector of society that needs somewhere cheap to live, and having those in my portfolio is really nice. Some diversified REITs, some real estate services, and real estate holding and development. So that just totals up what different sector weights are in this ETF. And I'm just going to go down and show you that it's all Canadian. Just for the tax implications, I can actually hold this in a tax-free saving account. I am a Canadian, so for me, all this will grow completely tax-free. I do have US holdings, I do have international holdings that I'll get onto in a later video, but for this, I went with an all-Canadian version of the REIT ETF, just so that I wouldn't have to pay any income tax, any capital gains tax, any dividend tax on these going forward. And because REITs give out distributions, not dividends, and there's capital gains and there's other different increases and like stuff you receive in that total distribution, the tax implications are kind of annoying to do because you have to fill out different forms for different things. So for me, holding this in a TFSA, it's all Canadian, so I don't have to worry about any tax implications, is the best move for me at this moment. So those are my 2 purchases in February. As you can see, the market just opened for the day. Just slight decrease just to start the morning, which is nothing to be worried about. So as you can see, that's pretty much it. Every month I'm going to go over the purchases I made. As always, if you enjoyed the video, please subscribe, like the video. I'm the Gen Z investor. I work every day to help grow this portfolio and share with you my progress so I can help motivate someone else to start investing and create a better life for themselves in the future. Thanks for listening. I'll see you next time.